In 1865, Congress chartered a bank built specifically for people who had just come out of slavery. It was called the Freedman Savings and Trust Company, and within 9 years it had grown to 37 branches across 17 states and Washington, D.C., holding the savings of tens of thousands of Black Americans. Soldiers, farmers, cooks, laborers, people who had never in their lives been allowed to legally own anything, now being told, put your money here, it's safe. In 1874, it collapsed. Mismanagement, fraud by the bank's white trustees, and a national financial panic wiped it out in under a decade. Tens of thousands of depositors lost some or all of what they'd saved. Some eventually got partial repayment. Many never got anything back. This video is about what happened next, not just to the people who lost money in 1874, but to the generations after them, and the decision a lot of Black families made and kept making for the next 150 years. Keep some of it close. In a can, in a Bible, in a drawer. Somewhere no bank, no board, and no stranger could reach it first. Start with the bank that broke the promise. Picture the moment. The Civil War is ending. Nearly 4 million people are coming out of legal slavery into a country that has never built an economy for them to own anything in. For the first time, many of them have wages. Union soldiers have back pay. Freed laborers have small earnings. Congress does something that looks, on paper, like the start of real financial inclusion. It creates the Freedmen's Bank in March 1865. The pitch is simple: a savings institution for the newly freed. A place to build the first generation of Black-owned wealth in America. People believed it because the charter came from the same government that had just ended slavery. Depositors put in real money for real plans. A few dollars toward land, a few dollars toward a house, a few dollars so a child wouldn't start from zero the way they had. The bank's ledgers recorded names, ages, occupations, spouses, children, parents, and for families torn apart by slavery, those pages are still some of the only surviving proof certain families existed together at all. But depositors were never told the full truth about how their money was being handled. As the bank expanded, its white trustees moved deposits into risky, speculative loans, including loans tied to railroad ventures, far outside what a conservative savings bank should have been doing. When the Panic of 1873 hit, those bets collapsed and took the bank down with them. On June 29, 1874, Congress passed the act that shut it down. There was no FDIC, no federal deposit insurance existed in 1874. That protection was still 59 years off. When the bank failed, the money was just gone, and depositors were left to petition the government for partial repayment, a process that dragged on for decades and never made most families whole. This was the first large-scale, government-connected financial institution built for Black Americans in this country. It lasted 9 years. Here's the part that matters for the rest of this video. This wasn't a private company quietly failing. It was chartered by Congress. Abraham Lincoln's name was tied to its founding mission. Frederick Douglass was brought on as its president in its final desperate months, walking into a building whose books were already unfixable. So when it failed, the lesson that traveled through families wasn't one bank made bad loans. It was closer to this. A government-backed institution with a marble counter and men in suits can still take everything, and there may be no one who forces them to give it back. That lesson didn't stay in 1874. It got passed down the way survival lessons get passed down, not as a history lecture but as a habit. A grandmother who says keep some back. A father who counts the bills himself instead of mailing a check. An aunt who always seems to have $20 nobody else knew about. None of that means people stopped trusting banks entirely, or that they were uneducated about money. Many Black families used banks. Many built their own. What it means is that an entire population learned, from direct experience, that trust in a financial institution had to be earned, and that the cost of misplaced trust could be a family's entire savings. If the Freedmen's Bank had been an isolated incident, this story might have faded in a generation. It didn't fade because for the next 100 years, the pattern kept repeating in new forms. After Reconstruction, most mainstream banks in the segregated South either refused Black customers outright or offered them worse terms than white customers for the same services. Black-owned banks rose to fill that gap. More than 100 were founded between the late 1800s and the 1930s. But they operated with less capital, less access to emergency support, and less room for error than white-owned banks, which left many of them fragile during downturns. Then came redlining. Starting in the 1930s, federal housing maps graded neighborhoods for mortgage risk, and neighborhoods with black residents were overwhelmingly marked in red, the lowest hazardous rating, regardless of the actual financial stability of the people living there. That single administrative decision made it dramatically harder for black families to get the mortgages that were helping millions of white families buy homes and build generational wealth in the same decades. Then came decades of predatory lending, contracts, subprime mortgages, and loan terms aimed specifically at black borrowers that were more expensive and more likely to fail than equivalent loans offered to white borrowers with the same income and credit. Line up a government-chartered bank that collapsed, a housing system that graded black neighborhoods as bad risks by default, and a lending system that repeatedly targeted black borrowers with worse terms, and the question stops being, why didn't they trust the bank? The real question is, what exactly was supposed to convince them? Modern research backs this up. Surveys on financial trust have found black Americans reporting significantly lower trust in financial institutions than white Americans, and researchers connect it directly to this same chain of documented history, not to a lack of financial knowledge. What usually gets left out when this story gets told as just a tragedy: black communities didn't simply retreat from finance, they rebuilt it themselves. Long before the Freedman's Bank existed, free black communities in northern cities had already created mutual aid societies, organizations where members paid small regular dues and in return received help during sickness, unemployment, disability, or death. The first known black mutual aid society was founded in Newport, Rhode Island in 1780, decades before the Civil War even began. These weren't social clubs. They were financial infrastructure, built and run entirely by black communities, operating before a single black-owned bank existed in America. After Reconstruction, that same instinct scaled up. Black-owned banks, black-owned insurance companies, fraternal orders, and burial societies gave communities financial tools mainstream institutions denied them. These institutions made mortgages and business loans to people the rest of the banking system refused to touch, and kept the money circulating inside the same neighborhoods that had earned it. At the household level, families built something more direct: rotating savings arrangements, where a small group agrees to contribute the same fixed amount on a schedule, and one member receives the full pooled amount at a time, on a rotation until everyone's had a turn. No credit check, no collateral, no waiting on a stranger's approval, just people who trusted each other, solving a problem the formal system wouldn't solve for them. So the envelope in the kitchen drawer was never the whole plan. It was one piece of a much larger, self-built financial system: cash close for emergencies, saving circles for larger goals, black banks and insurance companies for bigger institutional needs, and family documents like Bibles and deeds, kept together because paperwork, for a lot of these families, was armor. None of this means keeping cash at home was risk-free, and it's worth being honest about that. Cash outside a bank can be stolen. It can burn in a house fire. It can be lost in a flood. It earns no interest, so its value slowly erodes with inflation instead of growing. Money kept permanently outside the formal system can mean missing out on tools that help build wealth over a lifetime. Mortgages, retirement accounts, business credit. That's not a case against the grandmother with the coffee can. It's a case for understanding exactly what problem she was solving, and being honest that the solution came with real trade-offs she likely understood better than anyone lecturing her about it today. Today, money in an FDIC-insured bank account is protected up to federal limits, a protection that came directly out of the wave of bank failures during the Great Depression, when Congress created the FDIC in 1933, specifically to stop what happened to institutions like the Freedman's Bank from happening again. But a policy change in 1933 doesn't erase a lesson a family learned in 1874 and reinforced in 1934 and reinforced again in 1994. Trust doesn't reset on a government's timeline. It resets when the harm stops repeating. There's one more layer to this that's easy to miss if you only look at the numbers. When people remember the money hidden in the house, they don't usually remember it as fear. They remember the person who kept it, the specific way she folded the bills, where exactly the can sat on the shelf, the look on her face if a child got too close to that drawer. For a family without a safety net, being able to handle a crisis, a sick child, a broken car, a missed paycheck without asking a landlord, a boss, or a stranger at a bank for permission was financial planning, but it was also dignity on a family's own terms. That's also why cash often sat near a family's most important documents: a deed, a birth certificate, a photograph, a family Bible. For families whose histories had already been broken apart once by slavery and displacement, keeping proof of who you were and what belonged to you within arm's reach wasn't paranoia. It was a rational response to a country that had shown more than once that it could take everything and leave no record behind. That's the real inheritance in this story. Not just money. A system, imperfect, self-built, occasionally risky, that let a family survive on its own terms when no institution had earned the right to be trusted with that responsibility yet. In 1874, a government-chartered bank collapsed and took the savings of tens of thousands of black families with it. For the 150 years after that, banks kept finding new ways to repeat some version of the same betrayal, through redlining, through predatory loans, through decades of unequal access. So some families kept a little cash close, not because they didn't understand money, because they understood exactly what money meant when no one was coming to protect it for them. Did someone in your family keep cash hidden somewhere in the house? A Bible, a coffee can, a mattress, a dresser drawer? Tell me where and what they called it in the comments. I want to see how many different versions of this same story we're all carrying.